welcome everyone. My name is Christine Joyna with the Farm to Consumer Legal Defense Fund. We're very happy to welcome you to our members only webinar today on business entity formation. I am going to turn this over for a minute to our Executive Director, Alexia Kulwick, to say a few introductory comments.
Thanks, Christine. Yeah, I just wanted to say, again, I'm Alexia Kulwick, and I wanted to welcome all of our members. Thank you for all being our members, and for those of you that may have joined because you saw that we have these great member-only resources, I thank you for that as well. And I'll just say about today's presentation is we do regularly get questions about business structures and entities and forming LLCs or an S Corp, for example. And doing that work is outside the mission of Farm to Consumer Legal Defense Fund, but we also feel it's a very, very important part of your business. And so we're just thrilled to have guests that are experts at this today to teach us all more about the details of forming the right business structure for your farm business. So I'll turn it to you, Christine, to introduce our guests, and thank you all so much.
Great, thank you. And I just wanted to remind everybody, we are in a webinar format, which means you are muted just to reduce background noise. But please feel free to go to the Q&A area of your webinar window if you want to submit some questions, and we may address them as we go, depending on how the flow is, but we will certainly reserve time at the end for Q&A. With that, I'm going to introduce our presenters. We have with us today Patrick Connolly, Chasse Osborn, and Tanisha Edwards of the law firm Foley Hoag. Patrick, I'll turn it over to you.
Great. Thank you, Christine. Thank you, Alexia. We're all very glad to be here today. Although we can't see you, it is nice to be interacting with you in this webinar format. We have a lot to cover in a relatively short amount of time. Christine and Alexia are going to try to facilitate real-time question and answer during the flow of the presentation if the question sort of naturally fits within that flow. Otherwise, we'll try to leave some time at the end of the conversation for questions. I want to turn it over and get to the substance right away, but I do have to mention at the outset that this presentation does not constitute legal advice, and nor is there any lawyer-client relationship formed by virtue of us joining you in this forum today. So with that out of the way, I'll turn it over to my colleague, Tanisha Edwards, who is a corporate attorney in our New York office. And I'll mention that Chasse Osborn is a tax attorney in our Boston office where I sit. You'll find that this is a very tax-intensive analysis when it comes to determining which entity to form for your business. So we'll get into the tax weeds a little bit, but we'll try to keep it as user-friendly as we can. So with that, Tanisha, why don't you take it away?
Thanks, Patrick. And next slide, Christine, thank you. And as Patrick noted, we'll do a lot of the tax treatment as we go, but this presentation is more for entity considerations for your company. And this is a quick agenda of what we'll be discussing today. So we'll have what types of entities that you should consider, and then entity structure, which is the types of entities you can form for your company or even convert your current company to. Then we have your tax treatment, which for each type of entity, and we'll discuss issues that you should be aware of. The next thing we'll also discuss is approaches to executive compensation. In this section, we'll discuss equity compensation and different options on compensating those working for the company, like consultants or advisors that you want to hire. And then lastly, we'll discuss exit strategies. So say you would like to dissolve or transfer your company. What are your options for an exit strategy? Next slide, please. All right, so entity types. There's no one size that fits all. So we're going to go over all of the main types of entities that you can look for and look to form your company. So we have sole proprietorship. This is mostly a business owned and run by one person. So in this type of entity, the sole owner is entitled to all profits, but is also responsible for the business's like debts, losses, liabilities. Next, we have general partnership. This is an entity in which the owners are called general partners, and they're engaged in a for-profit business. The next will be a limited partnership. This is an entity that's formed similar to a form of general partnership, but limits liability for what we would call limited partners that are owners of the company, and also will have at least one general partner for similar to a general partnership. Next will be a limited liability company is another entity you can look at, which many of you are probably aware of this type of entity. And this is another entity that's used to limit liability of the owners. Next, we have a limited liability partnership. So this is a partnership in which some or all of the partners have limited liability. So this is another form of limiting liability for the owners of the entity. And then lastly, we have a corporation, which is an entity authorized by the state to act as a single entity separate and apart from its owners. And so we'll go further into these are special tax treatment as well for an S corporation and C corporation, which we'll dive into later in the presentation. Next slide, please. So this slide is just to show the ease of formation of forming the types of entities that I just previously listed. So first, in order of ease, would be a sole proprietorship. And like I said, this is just a single owner. So a lot of this is a default to a sole proprietorship. The next would be a general partnership. A corporation will be next, and then more complicated, but still something that you can form, especially with legal assistance, would be a limited partnership or a limited liability company. Next slide, please. So this is a slide that we will jump into more of like the choice of entity factors. Like, what are the things that you should be thinking about when choosing the type of entity you want to form? So for first will be number of owners. How many owners do you want to have of your company, or shared ownership of the company? So for a C corporation, that will be one or more shareholders that you can have for that type of entity. For an S corporation, you can have 1 to 100 shareholders. So that's another option if you have a lot of people that need to join into the company. And then lastly, on the last column would be your LLC, which is your limited liability company, LLP, limited liability partnership, and then a partnership. So the number of owners here could be 1 or more for an LLC, and then for a partnership, which, so it's like, you know, you have to have a partnership, 2 people have to be a partner. That would be for an LLP or a general partnership. So you have a lot of wiggle room with the types of or amount of people that can own or have an interest into the company. So that is not a huge factor you should probably consider. The next would be oh yeah, go ahead, Patrick.
Oh, sorry, go ahead.
I was going to go next would be the types of owners. So the types of owners, it discusses like what kind of restrictions that you'll have for who can be an owner or have an interest into the company. And for a C corporation, there's no restrictions. And for an S corporation, there's no restriction for the type of ownership for corporations other than tax exempt organizations, which we'll discuss later. And then there's that non-resident aliens, partnerships, or certain trusts. And so those are factors you should consider when thinking about who will be a part of your entity. And then lastly, for LLC, LLPs, and partnerships, there's no restrictions on that too. So I think as you can see, for S corporations and the types of ownership, that will be a bigger discussion to see who you're thinking about and going into those factors as well.
Let's just pause for 1 second and stipulate, you know, when we're thinking about the factors that go into choosing which entity you're going to form for your business. You have already made a decision to form an entity to begin with, because if you think back to that previous slide where there's a order of complexity in terms of forming the company, you'll recall that it doesn't take a heck of a lot to form a sole proprietorship, right? When my 9-year-old daughter goes out to the driveway and puts up her lemonade stand, and she does an amazing job. She absolutely crushes it. She's a sole proprietorship, right? So she becomes liable, and the next slide gets into this important point, but she becomes liable for all of the obligations and liabilities and torts of the business. Similarly, a general partnership can be formed whether you want to or not. So if Tanisha and I decide to go run that lemonade stand together, and we either through course of dealing or through a handshake agreement say we are going to split all the costs of the inputs and the ingredients and the advertising, and we're going to split all the profits 50-50, that's a general partnership. And you know, congratulations, Tanisha, you are now jointly and severally liable for everything that I do as part of that business. And if I go and, you know, back the lemonade truck into a, you know, somebody's parked car, that's on you as well as me. So you have to be pretty careful when it comes to, you know, making the affirmative choice to form an entity to begin with is an important choice, because you've decided to limit your personal liability by putting one of these entities in place. And the next slide is spot on there. But I just wanted to flag the fact that you could inadvertently create a general partnership where you get into a little bit of hot water with that joint and several liability with, you know, one or more partners. And Tanisha, we can go to the next slide.
Actually, I was wondering if this is Christine, before we move on, a question did come in as to the first point about number of owners. It asked, does a husband, wife count as one person or two?
Yeah, I saw this question, and it you know, I started to puzzle over it. That's a tricky question. I mean, I think from, you know, if you think about I have plenty of clients who have made either the wise or the unwise decision to go into business with family members, including husband and wife teams. Typically when they are formed when they form an entity of this type that is a creature of a state statute, either a corporation or an LLC, their economic and control characteristics of their ownership is separate. So it would be two, right? So my wife and I could form a business where she owns 75% of the equity interest, either the capital stock or the membership interest in an LLC, and I own 25%, and we enter into a business contract where she gets to vote in favor to elect the management of the company and so forth, and I don't, and you can slice and dice the economics. I think it's a little bit different from a tax perspective, you know, depending on how you're filing your taxes. If you're filing, you know, jointly as a married couple, Chase, you can probably speak to this, but I would imagine that all the business income ends up going to the same place.
Yeah, and it's also going to depend on state law. So what is the underlying state law and whether you're in a community property state or not. As far as S corporations and the number of shareholders, there are rules that can limit if you're, because in the S corporation context, it usually only comes into play if you're trying to avoid exceeding the requirement, exceeding the number of shareholders that are permitted. And there's rules that, you know, that will treat members of a family as one shareholder for purposes of those rules. On the partnership side of whether you've created and we'll get to this a little bit, but on whether you've created a partnership or whether you have what's called a disregard entity, that's going to look to kind of what Patrick was describing, how you file your taxes, and also to state law and whether your ownership interest in the partnership is a single interest or multiple interests.
Good
Thanks,
question. Thanks for working it in. That is how I was hoping this would work. So I think we can move to the next slide. I see a question just came up in the chat, and we will cover that. So we can just leave it open so we don't forget.
Great. Patrick kind of already alluded to this, and I would say kind of explain most of this slide, but going next slide, please, Christine. This slide, yes. But similar to Patrick's lemonade stand example, say the lemonade stand does run into a car, and who can the car owner potentially sue? And in this list, who's the limited liability owners in your sole proprietorship, is there a limited liability? No, you're on the hook for all of the damages potentially. For a general partnership, as Patrick discussed, you're on the hook for all of the liability for that as well, because there's no limitation. You're the sole owner or the sole owners of that company. For a limited partnership, which you can probably see where the name starts adding limited in the front, that kind of tells you when there's a limited liability for the owner. For a limited partnership, there's the limited partners are those individuals that that have that limited liability. For a corporation, the owners have limited liability, which means that the car owner will have to sue the corporation separately from the owners. Then you have your limited liability partnership as well as your limited liability company. That also separates the company from the owners as to who's liable for any of those damages from that car. Next slide, please.
Do you want to just pause there for 1 second?
Oh,
I want to just amplify a couple of things. So on the general partnership, I said it before, but you just want to be cognizant that it's, this is joint and several. So once again, if Tanisha, Chase, and I form an entity and I, through my, negligence, cause $1 million of property damage, Chase and Tanisha are just as liable as I am for that $1 million, up to the entire amount of the $1 million. So something to be very careful about. There are plenty of companies that are out there running as sole proprietorships and general partnerships. And folks who run their businesses that way limit their risk by buying insurance. And there's a question in the chat about whether filing or forming an LLC would lead to lower liability insurance costs. I don't actually know the answer to that question. I think there are plenty of insurance brokers out there, and we can refer you to good ones who could walk you through some of that. But just keep in mind the difference between the limitation of personal liability and the ability of a company to pay for to cover its own liabilities, right? Because if you have an entity, either an LLC or a corporation, between the owners, right, where you've separated the economics and the management of the economics of the business from the management of the company in a way, that company still needs to be protected through typically that company will still be protected through business insurance. So that a little accident that causes property damage isn't going to put the existence of the business at risk. I would just also say the rest of this presentation is likely to focus on corporations, both S corps and C corps, and LLCs, limited liability companies. I think we included these other entities in here just for the sake of completeness, but LLPs or limited liability partnerships tend to be, our law firm is formed as an LLP. Those tend to be, professional type organizations. Limited partnerships tend to be investment vehicles. So if anyone out here is, raising outside capital, you might end up doing a transaction with a limited partnership where the limited partnerships put their money in and basically hire one general partner to actually do the business of the company. But for operating businesses, 99% are formed, not 99% that do form entities are formed either as corporations or LLCs. Next slide, please.
Okay, so the next group of things that we're going to discuss is entity structure. Next slide, please. So ownership structure. This won't be a deep dive, but the chart kind of speaks for itself on the types of entities, the number of entities, and the limits on or types of owners, which we kind of previously talked about. So for a C corporation, the minimum number of owners is 1. And is there a limit on the number or type of owners? No. So similar to what we discussed, you can have one owner, you can have 50 owners, you can have 100 owners in a C corp. An S corp similar with the minimum is 1, but they do have that limitation that we discussed earlier about the maximum is 100 shareholders. Similar to what we kind of previously discussed about family ownership, there is a carve out for family members may count as one shareholder. So that's something you need to discuss with your accountant, your attorney on that point too, just to make sure you qualify for that. None of the shareholders can be non-resident aliens. They can't be a partnership or LLCs, other than LLCs that are disregarded for tax purposes, which we'll discuss later in the presentation as well. And then none of the shareholders can be a for-profit corporation or specific types of trusts. So what I previously alluded to, S corporations have certain restrictions that you should definitely walk through with your attorney regarding the types of owners that you're going to allow to be a shareholder. So just to make sure that those exemptions are met, so you can still qualify to be an S corporation. And then lastly, we'll speed through where limited partnerships, 2 owners minimum, which we already discussed. And then there are limits, no. Limited liability company, minimum owners must be 1. And if there's no limits on the type of owners as well. Next slide, please. All right, capital structure. So for capital structure, is there flexibility through how you can structure the capital of the company? So for example, say you have a company where you want some owners to have voting restrictions, or some owners you want to allow to vote for the management of the company, and you want to have some owners not be able to vote on the management of the company. For a C corporation, yes, there's flexibility, and then you have that flexibility through the classes of stock. So for example, you can have Class A stock owners can vote on the management of the company, but Class B owners, they cannot vote. They're just part of the company for profits and losses. That's another way to distinguish that. For S corporations, is there flexibility? No, except for voting rights. So similar to the example, you can kind of cut off the flexibility for voting on management by having a different class of stock for those that for owners that you don't want to be able to vote for management or business decisions of the company. Limited partnership, is there flexibility? Yes. Similar to C corporations through classes of interest. Instead of stock for a corporation, limited partnerships and limited liability companies categorize their equity through interests of the company. So it's equity interests of the company, versus in a corporation, you would be a stockholder or a shareholder of the company. Next slide.
Just to put a little bit more color on the S corp limitation. So what that's basically requiring is that you can't make varying types of distributions or varying economics between different shareholders. Everybody in an S corp has to be treated exactly the same as far as the economics go. So you can vary voting rights. So as Tanisha said, you could have some shareholders that can vote, some shareholders that can't vote, but you wouldn't be able to have kind of differing economics. So you couldn't have a shareholder get the first, X number of dollars, and the next shareholder gets the next Y number of dollars. Everybody has to kind of be participating in distributions equally based on their stock ownership.
Thanks, Chase. That's actually a good point to know. For your economics, those other 3 would be great to think about if say you have an investor that wants to invest and you want to be able to pay that out first, you can have that differentiation and structure.
Yeah, exactly. And I think there was a question that came in before the presentation about what are the differences between an LLC and an S corp, and that is one of the major differences. We'll get to the tax treatment, but the ability to kind of vary the economics between the owners is a benefit of an LLC that you are not able to do with an S corp.
Thanks. And then Christine already went to the next slide. So this is the management structure. So this is, we're going to go through a couple of types of the corporate entities to show you how they can be managed. So for a corporation, you'll have shareholders, which represent SH at the top of the corporation, which represents the owners of the corporation. Now, who manages a corporation? Usually you will set up a board of directors, and those board of directors handles the management and the day-to-day business of the company. And then those board of directors can also give away or allow some other individuals as officers, so president, secretary, treasurer, to take on some of those tasks as well. And so that's kind of the management structure that's made for a corporation. So you have your shareholders or the owners, you have your board of directors that deals with the day-to-day businesses, and then you have your C-suite that you would call of officers, which is your president, treasurer, secretary, that handles those specific types of roles.
So I'm just going to pause here real quick and answer a sort of a fundamental question that came through in the chat, which was, would employees or the assertion, I suppose, is employees would be different than shareholders, correct? And the answer is yes, right? So in this cartoon, the shareholders up top are owning the entity, right? They own the corporation. That's called being an equity holder. So, think about it as a pie, and all the slices of the pie go to the shareholders, right? And you can slice and dice it up as finely as you want. But the shareholders vote their shares in favor of who they actually want to run the corporation, as Tanisha said, and the board can further delegate duties of running the corporation to the officers. And then, of course, not everyone who is part of a corporate enterprise is an officer. There are obviously many huge corporations with lots and lots of employees. So down below the officers, you'll have, often really, depending on the size and type of business, you might have a simple org chart with a few employees who report to their bosses, who report to their bosses, who ultimately report to officers. Or you might have, a giant multinational company where the employees are supervised, hired, and fired by the officers. Now, officers are employees of the corporation, but not all employees are officers. And you might have employees who actually are also stockholders. And we'll get into that a bit later when it comes to thinking about ways of using equity in your entity, whether it's a corporation or an LLC, to attract and incentivize talent, basically, right? So probably everyone's familiar with the concept of corporations giving out stock options or restricted stock units as a means of giving folks some compensation other than cash compensation. So that can make your officers and your employees also shareholders of the corporation. There's a lot of tax nuance and sometimes complexity to that, but I just wanted to highlight that in light of the question.
Thanks, Patrick. Next slide, please, Christine. Okay. And similar to a corporation, we have a limited liability company that has members. So for the owners of a limited liability company will be called members. Then you have your officer. For the management of a limited liability company, it's usually going to could be manager managed. So in this cartoon, you have managers that represent that would be in charge of the day-to-day business of the company. And similar to Patrick's point, you have your officers as well that can be designated by the limited liability company or can be designated by the managers. And so that's the manager managed structure of a limited liability company. Next slide,
Before
Christine.
you move on,
Yeah.
Can I ask one thing, Tanisha? I'm sorry, before you go on, because I
Oh.
think a lot of our members do the LLC structure. These members could also be a manager or the officer, right?
Yes, correct. Yes.
Yeah.
So
They
similar
don't need
to,
to have hired. Mhm.
yeah, exactly.
If you go back one slide, actually, there's an even simpler structure. So
Sorry, I didn't see
this would be an LLC that is managed directly by the members. And to a point, Tanisha or Chase, I forget who made earlier, these limited liability companies, their existence is a creature of the state statute in which you're in. And you'll look to your state statute to figure out how the management of the LLC works. And you'll find generally that the members of the company can describe in what's known as an operating agreement or a limited liability company agreement, which is just a contract among the members, how the company is going to be managed. So in a member managed LLC, you'd have a contract, and these contracts can be very simple or they can be very, very complicated. But in either case, that contract is going to tell each member is going to agree how this company is going to be run. And the members might say, well, we'll just run it together by, majority vote of, relative membership interests. But then if you go to the next slide, showing the manager managed, this is more of a corporate type LLC where your operating agreement will say, yes, the members own the company, but and often in the LLC agreements that we see, once the company grows up to a point where there's outside investors and employees who hold equity, you might end up with dozens or hundreds of members, in which case it's very unwieldy for the members to actually be running the limited liability company, in the same way that it would be very unwieldy for shareholders of a corporation generally to be running the company. So here the operating agreement would say the members will elect a board of managers, and the managers are entitled to do everything on behalf of the company, maybe except for, or usually except for, some list of really important life events in the life of that company, right? Selling the company, incurring aggregate indebtedness in excess of some number, liquidating the company, declaring bankruptcy, that sort of thing. So you can sort of divide responsibility up among the members, right? The members can make a as broad or as limited a delegation to the managers as they want.
And I will just chime in one thing. Managers, you can have one manager, you can have 5 managers. The members can be managers. Some of the members can be officers in this. So this is, as Patrick's saying, similar to a corporation style. And if there's no further questions on the management structure, we can move on to the next slide. And I think Chase is going to take over and do the slides for tax treatment.
Yeah, so now we'll get to the fun tax treatment of all these entities and how they'll work. So if we move to the next slide, we can kind of just talk a little bit about, what you want to consider when you're forming an entity. So how is the operating income going to be treated? Is it going to be on your tax return? Is it going to be on the entity's tax return? Is it going to be on both? How easy is it to form, operate, and exit? A partnership is going to be a lot more, from a tax perspective, a partnership has a lot more tax complexity and on an administrative day-to-day basis than a corporation does. How you can handle equity compensation to your employees and to your founders. There's different ways you can handle equity compensation if you're a corporation versus a partnership. And then finally, what are the tax consequences when you want to exit or sell the company? There's different tax treatment depending on if you're a C corporation, an S corporation, or a partnership. So if we move to the next slide, we'll talk a little bit about the general kind of how operating income is handled on a general basis, depending on the type of entity you have. So the first and the simplest is what's called a disregarded entity. So this is going to be your sole proprietorship. So Patrick's daughter running a lemonade stand. Similarly, if Patrick's daughter ran her lemonade stand through a LLC that she is the sole owner, that LLC is going to be disregarded for tax purposes. So it's going to be treated as a sole proprietorship. So what this means is that all of the operating income, all of the deductions, everything that the entity or the sole proprietorship does, it just winds up on your personal tax return. And so that's the simplest mechanism. Next up is other types of flow-through entities. So partnerships, multi-member LLCs that are taxed as partnerships, or S corporations, typically there's only one layer of tax, but the entity itself does have a tax return filing obligation. So the income, deduction, loss, everything flows up to the owners. But there's one more step of that the entity itself will have a tax return obligation that then basically allocates all of these items of income, loss, deduction to its owners. And then finally, what's called a C corporation. A C corporation has 2 layers of tax. So the corporation itself is a taxpayer. So when the corporation has income, it will pay tax on its income. And then when it distributes that income out to the shareholders, it will be taxed again. And one note here on the difference between a flow-through entity and a C corporation. The flow-through entity typically will have its income will be taxed whether it distributes it or not to the partnerships, or to its partners. And so you could have situations where the entity has income, doesn't distribute it, but the owners still have tax, they'll still have tax that they'll need to reflect on their income. And that's what's called in kind of the industry phantom income, which can be a problem. It can be totally fine depending on the circumstances. So if we go to the next slide, again, we'll get into a little bit more detail, but again, the disregard entities are single owner. There's no entity level federal income taxes. They're respected for legal purposes. So as Patrick and Tanisha were discussing on limitations of liability, an LLC that's a disregard entity for tax purposes will be regarded for the limitations on liability. It's just not going to be respected for tax purposes. It's going to be treated as if you're operating the business yourself.
So Chase, let me hit you with a question from the chat, which I think is, well timed here, given the slide that we're on. Cheryl asks, or Cheryl notes that she's planting fruit trees that won't produce revenue for 4+ years, but she has expenses now. So the question is whether it makes sense to form an LLC now to start expensing the purchases despite no revenue this year. I have a couple thoughts, but
yeah, I mean, if from a tax perspective, again, whether you if your goal is to create an LLC, so create a flow-through entity, I mean, from a tax perspective, whether you create the LLC now or you create the LLC in 4 years, it's still good, the revenue deduction, everything is going to be yours. It's on your tax return. Because again, if you form that LLC now, for tax purposes, that doesn't change, or for at least income tax purposes, that doesn't change anything. But Patrick, interested in your thoughts as well.
And if the orchard, I don't know what kind of fruit is being grown, but let's call it an orchard, because I'm from Maine and we have apple orchards there, not groves, I suppose. If you have a partner in the business and you formed an LLC, you would split the tax attributes of those expenses. They'd flow through, again, the entity to the partners K1s, and the tax attributes would be would apply to the partners, and generally in proportion to their ownership of the company.
Yep. And similar to Patrick's discussion earlier on kind of general partnerships, and that they can be created whether you like it or not. If this is a situation where you have a joint, have somebody that is, working on this together with you, and you create that general partnership, that's also going to be the same case for tax purposes. So then you are, even if you don't actually formally go through the process of filing a general partnership, if you are splitting, if you are splitting net income, if the goal is to split net income, however you decide to, you've now created a partnership for tax purposes as well. That comes with filing obligations. So again, a partnership does have a tax return filing obligation, even though the entity itself doesn't pay tax, and the tax or the deductions flow up to its owners, there still is a filing obligation.
Can I jump in before you move on? Oh,
Yep,
yeah.
absolutely.
This is what I was going to do, is clarify what Cheryl's got here. So if she forms the LLC, can she deduct those expenses today, even though, she won't have revenue for it? In other words, if she waits 4 years, she can't deduct the expenses she's paid this year, next year, and the year after.
Yeah, and again, so it's, and again, this gets in, there's some limitations on whether this is a hobby or not, and I think that's a little bit beyond the scope, but whether or not you form the LLC now or in 4 years, again, if she's the sole owner, the deductions are going to occur this year, no matter whether you form the state law entity or not.
So another way of saying is that forming the LLC isn't a prerequisite to taking the deductions.
Yeah.
Right.
Yeah, go ahead, Patrick. Sorry.
I'm sorry. So I was gonna say, if you're planting the trees as part of the fruit growing and selling operation, and you're doing so as a sole proprietor, those business expenses would hit your personal tax return and would benefit you personally.
Yeah, I mean, the important concept here is whether you're actually whether you're running a business or not. And again, I don't want to get into it. I don't think it's, the scope of what is a hobby and what is a business is probably beyond the scope of here. But if you're running a business, if you're running a business, those deductions will flow up whether you create an LLC or not. So next slide. And so flow through entities, again, typically putting S Corp aside for a moment, it's 2 or more owners. So it's 2 partners, 2 members. And again, you could have a general partnership, whether you like it or not. Typically, there's going to be no entity level federal income tax. State law can treat things a little bit differently, depending on the state. But for federal income tax on a flow through entity, a partnership is typically not going to have any entity level taxation. Everything flows up to the partners or the members of the owners. But again, there is a annual tax filing. There are tax filing obligations on the partnership. And then again, as I discussed a little bit earlier, the tax occurs whether the distributions are made or not. But if you are taxed and then you later distribute it, the distributions are generally non-taxable, subject to certain exceptions in particular cases. So moving on to the next slide. So finally, a corporation, you can have 1 or more owner. Its tax treatment depends on whether it's an S corporation or a C corporation. And those are kind of the distinction between an S corporation and a C corporation is a tax. It's a federal or state income tax mechanic. It's not like you form a Delaware S corporation or a Delaware C corporation. They're all the same. It's your tax status. And again, these will also have annual tax and entity filing requirements. And so if we move on to the next slide, again, specifically how these are going to be taxed. So C corporations are a taxpayer themselves. So they have their own tax rate of 21% on their income. And then again, when you distribute that income in the form of dividends, which are it's what's called earnings and profits. And so if you have earnings and profits and you distribute those earnings and profits to your shareholders, there's a second tax that can be taxed at a rate of 20% if it's a qualified dividend, which is a technical analysis that we don't need to get into here. But the concept here is that there's 2 layers of tax. So the corporation will pay tax on its income itself. And then when it distributes that income, it's typically taxed again.
So just to put some simple numbers on it, and sorry to interrupt, if the company makes $100, the corporation makes $100, the corporation is going to pay to the federal government $21 and be left with $79. And then if the corporation is sitting there going, well, we've paid all of our, there's nothing else to do with this money, we are going to distribute it out to the stockholders as a dividend, you'll pay another 20, the stockholders themselves will pay a 20% tax generally on that $79 dividend, and left in the stockholders' pockets will be roughly $63.20. And that gets down into these, and sorry, Chase, to step on your presentation here because I realize this is coming up. So that assumes a 100% distribution of that remaining income after the federal tax is paid. You can see there and I want you to make a note of this mentally. The effective tax rate, notwithstanding the double tax, right now is 36.8%. And you can see what the effective tax rate is if the company distributes only a portion of that remaining $79 or none of it, and instead plows the whole $79 back into the business to grow the business. Sorry, Chase, go ahead.
Yep, and yeah, and so that what Patrick illustrated there is the double, what you commonly hear as a double taxation of corporations. So if we move to the next slide.
Can I ask one
Yep.
thing before you move on? Just because I think this is done a lot by our members. If they pay themselves out as an employee, that's different than a dividend. So that could be deducted before you're looking at what the profit is that the entity would be taxed as.
Yep, yeah, so and the benefit of a corporation is that a corporation, its owners can be employees, they can be W-2 employees, and specifically with S corporations, there are requirements that you pay reasonable compensation to your owners who are employees. And to that point, you do get to deduct the corporation does get to deduct the salary payments. There can be potential. So again, going back to an earlier question of what's the difference between an S corporation and an LLC? One of the differences is that a owner of an S corporation can be a W-2 employee, whereas the owner of an LLC that's taxed as a partnership cannot be an employee. And so you're going to be responsible for you're going to frequently be responsible for self-employment tax. And there can be potential tax savings depending on the circumstances by choosing to be an S corp versus an LLC because of this idea that you can be an employee. You can be an employee of a corporation. So then moving on to how kind of a flow-through entity will be taxed is that there's generally only one level of tax at the owner level. So again, you'll compute all of the income of the S corporation or of the partnership on an entity level tax return, but the entity itself is not generally the one responsible for paying that tax. That tax then gets reported by the shareholder, and the shareholder or the owner is the one paying tax. And then just to note that there are potential deductions for qualified business income that can be available to owners of certain flow-through entities. And so as Patrick noted earlier, that 36.8% on the combined rate, this is the 37% is the typical highest rate for individuals. So before this qualified business income deduction, you may have a higher tax on the flow through than if you do distribute 100% of the income. But again, that qualified business income can be a consideration depending on the type of business you're running and the owners of the business.
So this brings up an important practical point. I think your lawyers are going to be your friends at the outset when it comes to forming a business entity, if there's any complexity to it at all. And I want to get into the nuts and bolts of how you actually form these entities a little bit, but also your accountants and tax advisors are going to be critical allies as you sort of puzzle through what is what is going to be the optimal business entity for you and in your particular situation. So especially if you end up forming as an LLC, I think on an ongoing basis, having a good accountant engaged to help you with the partnership tax aspects of that is important.
Yep. And just a quick touch on another kind of entity type is a cooperative the goal of the cooperative is to allow anything it's doing for its patrons, anything it's doing for its patrons or on behalf of its patrons or transacting with its patrons. The goal is to create a single layer of tax similar to an S corp or an LLC or a partnership, so it's only being taxed to the patrons themselves. The difference is anything that's not done for the patrons or not done in connection with the patrons then is typically treated as a C corporation. So there will be an entity level tax and a tax on its distributions. So the next slide, please. Just a quick note about, because this may come up and you may hear what is qualified small business stock. Qualified small business stock is a provision in the code that basically permits the sale of certain qualified small business stock to be completely exempt from federal taxation. Unfortunately, one of the problems in this context is that you need to be in a qualified trade or business, which farming and restaurants are typically not a qualified trade or business. They're specifically excluded. So there may, depending on your business, there may be avenues around that a little bit, but farming and restaurants are specifically excluded. So it's just something to keep in mind if you hear about this. So moving on to the next slide.
Do you want to,
Yeah.
sorry to interrupt, but Alexia and Christine, do you want to hit the RSA? And is am I getting that acronym right?
No, I think let's just keep going, and if there's a question on something else, we can address it.
Yep.
Okay.
Yeah, and I don't know how you guys feel about time. We have a little less than 10 minutes. I mean, feel free to keep speeding through the slides, or if there's other points you wanted to make sure you got to.
Yeah. Do you want me to hit the equity comp piece, Chase, real
Sure.
quick? So if we can go to the next slide. I just wanted to make the point here that these entities, either a corporation or an LLC, can use ownership in the business equity to attract, retain, and incentivize talent, employees, and independent contractors. This is a construct you see often in early stage startup companies, tech companies, biotech companies, you name it, consumer companies. We hear, most of the agricultural businesses we represent at this firm are actually cannabis companies, both THC and hemp. So we represent a lot of cultivators in that space, and they use equity compensation frequently. I just wanted to fly over this a little bit. So in a corporation, issuing equity compensation is reasonably simple. There's a well-worn path to doing that by way of giving employees or other service providers a right known as an option to purchase some number of shares at a particular exercise price. So an employee can basically earn that right over a period of time. And if they want to buy into the business at that preset exercise price, which has to be set at the fair market value of the stock as of the date of grant, then they can buy into the company at that price as they earn that right. In a very early stage company, you can also do outright grants of restricted stock or common stock. When the value of the stock is very low, you do have an opportunity to grant those shares of stock outright to service providers. Just note there that is taxable income to the recipient, even though it's illiquid private company stock that you cannot pay the IRS with. The IRS will not accept that to pay your federal taxes with. So if you receive equity compensation in the form of stock that's worth $1,000, you have received income of $1,000, and you need to come up with cash to pay your taxes on that income. But there's a lot of nuance and contracts and board consents that need to happen around that. So you'd want to work with your lawyer on those things. Allocation of equity is generally something you want to think of very early in the process and have frank and candid conversations with anybody you're working with about who is going to own what, and what they're going to have to do to earn the right to keep those shares or earn those shares over time. But a good legal advisor can walk you through that, and it's best to get on top of that as early as possible in the process. We can go to the next slide. LLCs can also issue equity compensation. I would say here generally it is significantly more complicated, more costly, and more confusing for the recipient. So if one of the characteristics of your business is that you wish to grant lots of equity compensation to lots of different contributors to the business, an LLC probably isn't for you, because as soon as you do that, you have added partners to your tax partnership. In the case of an LLC, you've added members to your LLC. They start to get taxed as partners in the LLC. You need to produce K-1s for them to do their taxes. They can no longer be employees. They're now partners. They get K-1s. So in our world where we're representing operating businesses, it's very it's very infrequently the case where an operating business has as part of its strategy the issuance of lots of equity compensation, as a means of managing cash, or as a means of incentivizing talent, and they form as an LLC. If that's important to your business, generally folks are forming as C corporations. Next slide. Next slide.
Yeah, and just finally, we'll talk, and we can breeze over this pretty quickly, just kind of what does the end of the road look like and what's the tax treatment on the end of the road? And starting with, and we can go to the next slide and just start briefly with just a high level on tax-free reorganizations. These are, you'll frequently hear of tax-free reorgs, or, is my merger going to be a tax-free reorg? This only applies to C corporations and S corporations, and just very quickly, there are a number of very technical requirements, but it's typically just when a kind of corporation is restructuring. So it's the business is going to continue to run. The owners are going to still have an ownership interest. It's just in a separate form. So if it's merged into a new company where you still have that ownership interest in that new company, that could potentially qualify as a tax-free reorg. And so the exit event doesn't trigger tax immediately. It defers the tax still. But this isn't available for LLCs or partnerships. Moving on to the next slide. If the sale, and I think it's the next slide, sorry, Christine. If the exit is by way of selling all the assets, then it's kind of what we talked about earlier, that it's going to be for a C corporation, you're going to trigger the double tax. So the sale of the assets is going to be taxed at the entity level, and then the distribution of those proceeds out is going to be taxed again to the owners. However, an S corporation and a partnership will typically not have two layers of tax here. Will typically just be as if the sale of the business was in the ordinary course of business. It's going to trigger, the sale of all the assets are going to trigger income that will then flow up to its partners or its owners. The next slide, please. And then finally, another option is just selling the business. You're selling your ownership of the business. From a C corporation and S corporation, that's typically going to result in capital gain treatment. And whether it's long-term gain or short-term gain depends on your holding period. In the context of an S corporation, however, typically there's ways to structure this as a asset sale. And that's 99 times out of 100 times when a S corporation sold, it winds up getting treated as an asset sale, because again, there's usually only one layer of tax, and so it allows the buyer to get a step up in basis on their assets, whereas a sale of just the corporate stock would not. And an LLC and a partnership typically also gets capital gain treatment, but there's an important exception to this for certain ordinary income type assets, such as unrealized receivables and inventory. So even when the partnership or the LLC is sold, you're going to trigger ordinary income on these so-called hot assets, which are kind of like ordinary business assets. Next slide, please. And then again, if you just were to liquidate, and so if we're just going to close up shop and distribute all the assets to the owners, it's a similar concept. The corporation's going to have two layers of tax again. So even though it's distributing its assets to the owners, that is going to trigger gain or loss as if the assets were sold to the owners. And then again, there's going to be a tax on the shareholders on the liquidation itself. So the corporation pays tax on the liquidation of its assets, and then the owners pay tax again on receipt of those assets. An S corporation and an S corporation will have a similar result, where it's treated as if it sold all of its assets, and that flows up. A LLC and a partnership does have a particular tax treatment where the distribution of its assets are typically not taxable to the partners, with the exception of cash and certain other property that's treated like cash. And so if we move to the next slide, I think a final note on succession here for Tanisha.
Yeah, and I can breeze through this. I'm not going to read all of these, but these are just factors to consider when thinking about the succession of the company. Similar to what we discussed earlier, your management of the company, whether it's LLC, for example, if it's member managed, they kind of control the future of the business. So be cognizant of who you're putting in those leadership roles when you want to either transfer the company or through a trust, or to if you want to, provide gifts from the company or things like that. There's personal and estate tax implications that you should talk with your accountant and also your attorney about. But there's certain factors you should think about when it comes to, like, is this a family business that you want to pass through family members? Thinking about those things is important when deciding which entity to choose from. And next slide, please. Any further last minute questions? I know we're kind of over time, but.
Do you want to spend just a minute talking about this presentation is sort of choice of entity 101. There's a lot of data sort of dumped at a high level. Once the choice of entity has been made in consultation with your legal counsel and tax advisors and accountants, how do you actually go and form the entity? Like I said, it's a creature of statute. So generally, you can do it yourself. You can go to the Secretary of State's website in the state that you're sitting in. I think I was telling Alexia when we were preparing for this call that my wife just did this for a small business, a single member LLC. She had the benefit of, I hope she found it to be a benefit of me looking over her shoulder and saying, okay, do this and not that, maybe, so she has a manager managed LLC that she formed herself on the the Massachusetts Secretary of State's website. But each state will have its own, usually online, way to form a business entity, whether it's a corporation or an LLC. A next level up in sort of complexity and support would be an online service, right? Like LegalZoom, everybody's heard of. Clerky is another one. Stripe is another one. And they tend to be okay. We lawyers have a love-hate relationship with LegalZoom. We hate it because sometimes the output is sloppy and incomplete and not really well suited to the purpose. We love it because that means when all of that, kind of subpar work product lands on our desk, we get to charge a lot of money to fix it. So even if you're using one of those online services, which can have pretty good output if you follow all the steps and you're careful and thorough, it probably helps to have somebody looking over your shoulder who's done it before, just to get another set of eyeballs on things. Next level of sophistication and support would obviously be to hire a lawyer. And I would imagine that Alexia and Christine have a network of referrals to folks who can help or do office hours. If you ever have a one-off question for me or Chasse or Tanisha, you can feel free to just give us a buzz. We can try to give you a little informal steer in that regard. But once you've got your entity set up through the state, there are some things you need to do. There's some ministerial things, right? You need to get an employer identification number. That's like a social security number for a business entity. And and you can do that on the IRS's website, irs.gov. Usually that's a pretty seamless process. In the 5% of times where you kind of get kicked out of the electronic process, it can be a real hassle, as Chasse can attest to, but usually it's a pretty smooth process. If you have tax advisors or accountants who can help you, I would suggest you enlist their help a little bit on filling out that form and filing it for you, or get a little bit of advice if you've never done it before. But once you have that employer identification number and you have the evidence that the entity has been formed from the state secretary, in the case of a corporation, it's going to be a certificate of incorporation or articles of incorporation, depending on which state you're in. Colloquially, that's called your charter. Like the company's charter is its organic documents, like the constitution of the company. typically then you can walk into the bank with your charter and your letter from the IRS that says your EIN is this, open a bank account, and then you're kind of up and running. There's some other nuance. There's a little bit more to it. And I would suggest you get some advice as you go out and run and start to do this. But then on a going forward basis, I want to flag that just having the entity is great. But if you have that entity and you're still, mixing your business activities with your personal activities and mixing your personal funds with the business funds, paying for business expenses out of your personal checking account or out of your credit card, not, keeping a reasonable level of capital in the business, that fundamental impetus for forming the entity in the first place, which is to limit your personal liability for obligations and torts of the business, that's going to break down. So you need to respect the formalities of the entity. So observing corporate formalities, having board meetings from time to time, definitely not intermingling funds, treating the business as a separate entity and not just, I'm going to drop the legal term on you here, not just the alter ego of the founder is really important. Because if you take that company car and you smash it into somebody's property and it turns out that the plaintiff in that lawsuit finds that you were just running that business totally intermingled with your personal affairs, they're going to do what's called piercing the corporate veil. The company is not going to protect you. You personally are going to be liable.
Great. Thank you so much. Alexia, did you have any final comments you wanted to make?
No, at that last point about keeping the company separate from your personal was what was on my mind, and Patrick jumped right on it. So I just want to say thank you to everybody. When it comes to recommendations, I see in the questions as well, very much forming the LLC or an S Corp is a creature of state law, as has been said. So Patrick's talked about it being statutory, but it's state law. So it's hard to make one general recommendation on who or where to go for help. So just contact, for our members, just contact us. In many states, we do have recommendations for folks. But I just want to thank the three of you so much for your expertise and wisdom today. It was lovely to have you.
Great to be here. Thank you. And thanks to all the participants for hanging in with us. A lot to cover in 60 minutes. We didn't quite get it done. We got it done in about 70 minutes. So I appreciate you bearing with us.